In today's video, we're going to delve into the 9 most popular investment portfolio strategies. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. As people get smarter about investing, one of the key obsessions that I have commonly seen with many individuals is this: the obsession with designing the perfect investment portfolio. We understand the importance of buy and hold, the importance of keeping costs low, and the importance of using passive investments over active ones. And the answers to these principles are pretty straightforward. Buy broad market index funds with low expense ratios and hold them for a very long time. However, when it comes to constructing our personal investment portfolio, we can't seem to agree. If you just Google best investment portfolio, you're bombarded with thousands of comments regarding what people believe are the best portfolio out there. Warren Buffett's 2-fund portfolio, Boglehead's 3-fund portfolio, Ray Dalio's all-weather portfolio. The list never ends. So do you want to know the secret behind the perfect portfolio? It doesn't exist. It's like unicorns and Santa Claus. Yes, I've told my kids that they don't exist. Judge me all you want. Just like mermaids, there is no such a thing as a perfect investment portfolio. And if someone espouses that there is one, be highly doubtful. To be honest, no one knows what portfolio is going to perform the best in the future. Yes, are there a general rule of thumb we should follow when it comes to constructing a good investment portfolio? Of course. A good portfolio should be well diversified within each asset class and across different asset classes. But to know what specific allocation will outperform all others is akin to a fortune teller predicting who is going to win the World Cup in 2026. No one knows. But that doesn't stop us from continuously trying, right? So in that spirit, let's review the 9 most popular investment portfolio strategies that I've seen talked about the most. And just a heads up, there's nothing scientific about this list, it's just what I've seen within my circle. I'm sure I'm missing thousands more, so feel free to add to the list in the comments below. Also, for this list of portfolio ideas, I'll use Vanguard funds as my usual default, but similar low-cost portfolios can generally be made using Fidelity, Schwab, or iShares Index Mutual Funds, or ETFs. Alright, let's kick it off with the most simplest portfolio out there. The first most popular investment portfolio strategy is the one-fund strategy. That's right, one fund. 100% in either the S&P 500 Index Fund or the Total Stock Market Index Fund. The Vanguard equivalent will be Vanguard S&P 500 Index Fund, the VFIX, or the Vanguard Total Stock Market Index Fund, VTSAX. Just one fund from start to end. No asset allocation, no second or third fund to complicate your portfolio. Just riding out the ups and downs of the market with this one single fund. You might think I'm just joking that this could be a portfolio idea, but I've actually seen people follow this strategy and done surprisingly well. And when I mean well, having a portfolio in the millions. Now mind you, some did it unintentionally, but I still commend them for their consistency. This strategy is as simple as you can get. Every investment dollar, whether in a retirement account or a taxable account, goes into the single fund. It is simple, very low cost, diversified among 500 or 4,000 different companies, and it has a long track record of exceptional returns. Now, my personal take is that this is totally fine when you're in your wealth accumulation phase. Think in your 20s, 30s, or even 40s. And I would actually highly encourage it if you're in this phase. But I do get a bit nervous about this strategy if you're nearing retirement. The stock market's long-term returns comes with a lot of short-term volatility, and you could be forced to sell at the least optimal time. Alright, moving on to the number 2 most popular investment portfolio strategy. A step up from the one-fund strategy, and as you can guess, the 2-fund strategy. You diversify your stock holdings with some bonds. If we were to construct a portfolio with Vanguard funds, it would look like the following. A good percentage in the Vanguard Total Stock Market Index Fund, also known as VTSAX, and also some in the Vanguard Total Bond Market Index Fund, also known as VBTLX. From a high-level perspective, the strategy follows the stock-to-bond ratio framework espoused by many personal finance professionals. It's a general rule of thumb to add bonds in your portfolio as you get closer to your retirement age to smooth out your equities holding. And the nice thing about this strategy is that it's simple enough with just 2 levers, stocks and bonds. And allows for slightly less risk than the one-fund portfolio that we just talked about earlier. It is also the strategy that Warren Buffett has set out in his will for his wife's trust. 90% in low-cost S&P 500 Index Fund and 10% in short-term government bonds. Personally, because I love simplicity, I straddle the line between 2-fund and the 3-fund portfolio we'll talk about in a bit when it comes to my personal investment portfolio. The number 3 popular investment portfolio strategy is a 3-fund portfolio, popularized by the Bogleheads, the self-proclaimed followers of Jack Bogle and the index fund strategy. It is probably one of the most talked about strategies in the index fund investing world. In addition to a US equities index fund and a bond index fund, you also add an international stock index fund. If we were to construct a portfolio with Vanguard funds, it would look like the following. A good percentage in Vanguard Total Stock Market Index Fund, VTSAX, some in the Vanguard Total Bond Market Index Fund, VBTLX, and also some in the Vanguard Total International Stock Market Index Fund, VTIAX. To be honest, despite its popularity, you can see there's nothing really special about this portfolio, especially when we compare it to the 2-fund strategy that we just covered earlier. It just adds some international flavor to the mix. And the argument around the effectiveness of international funds is a highly debatable one. You have individuals who swear upon the need for international diversification, whereas you also have individuals who will say US companies have enough international exposure built within them. I personally believe both arguments are valid, and I'll be the first one to admit that I don't know all the inner workings of all US and international companies to know what extent this is true or not true. So I do include a bit of international funds in my portfolio to be on the safer side, but not too much to make a significant difference. Alright, let's start moving on to some, I would say less conventional, but nonetheless popular portfolio strategies out there. The number 4 popular investment portfolio strategy is the 3-fund plus 1 portfolio, and the plus 1 being a REIT fund, Real Estate Investment Trust. Essentially following the 3-fund portfolio with just a little tilt towards real estate. Why? Because real estate is sexy. No, but in all seriousness, real estate does provide good additional diversity to your portfolio. If we're to construct a portfolio with Vanguard funds, it would look like the following. A good percentage in the Vanguard Total Stock Market Index Fund, VTSAX. Some in the Vanguard Total Bond Market Index Fund, VBTLX. Some in the Vanguard Total International Stock Market Index Fund, VTIAX. And now add the Vanguard Real Estate Index Fund, VGSLX. A REIT is a company that owns, operates, and finances income-generating real estate. But what we really need to know is that they're modeled after mutual funds. So buying a REIT is similar to buying index funds. Index funds allow us to buy publicly traded companies without buying individual stocks. Similarly, REITs allow us to tap into the real estate investments without having to actually buy, manage, and finance any properties ourselves. The Vanguard REIT, the VGSLX, represents close to 170 real estate companies that represent all different types of property investments in the real estate industry. Properties such as office buildings, hotels, and even residential homes. Now, I'll tell you that I do like real estate as a way to additionally diversify your holding. However, I personally prefer holding actual property just because I like the idea of being a landlord. But that is just a personal preference. If you like the 3-fund portfolio structure but would like to add a little bit more jazz, the 3-fund portfolio plus 1 could be a good option. The number 5 popular investment portfolio strategy is Dave Ramsey's 4-fund strategy. Now, I love Dave Ramsey. He is one of the first personal finance gurus that really changed my life, and I'm forever indebted. However, I'll be honest, I can't help myself but cringe a little bit when I review his investing strategy. He doesn't specify particular funds, but recommends dividing his mutual fund investments equally between 4 types of funds: growth and income, growth, aggressive growth, and international. Now, he does advocate for mutual funds, which I like, but he also says he has no problem paying commission for mutual funds, which means actively manage mutual funds. Again, I do love Dave Ramsey, but I have a very different philosophy on investing, so I'll pick index funds for the purpose of this exercise. If we were to construct a portfolio with Vanguard funds, it would look like the following. 25% in Vanguard 500 Index Fund, VFIAX, to represent the Growth and Income Fund. 25% in Vanguard Mid-Cap Index Fund, VIMAX, to represent the Growth Fund. 25% in Vanguard Small Cap Index Fund, VSMAX, to represent the Aggressive Growth Fund. And 25% in Vanguard Total International Stock Index Fund, VTIAX, to represent the International Fund. One downside to this fund strategy is that it's missing a bond fund. In addition, in the big picture, it's not that much different from a 3-fund portfolio, just adding more granularity by splitting out your US equities to 3 separate funds versus 1 like the VTSAX. Regardless, if you're a hardcore Dave Ramsey follower, this strategy could work. My only recommendation is to focus on low-cost index funds versus actively managed funds when constructing your portfolio. The number 6 popular investment portfolio strategy is Bill Bernstein's no-brainer portfolio. Bill Bernstein is an interesting character. Not only does he hold a PhD in chemistry, but he is a board-certified neurologist, a physician who studies the brain. And if that wasn't enough, he decided to write countless books on financial theories and investing. Kind of makes average people like you and I wanting to hide in our little caves, right? Well, Dr. Bernstein actually has a lot of asset allocation ideas, but one of his simpler ones is a no-brainer portfolio. An equal allocation across bonds, European stocks, US small-cap stocks, and the S&P 500. In his book, The Intelligent Asset Allocator, Dr. Bernstein examines academic research and historical performance to arrive at a relatively simple to implement portfolio that expects to perform well for the long term. If we were to construct a portfolio with Vanguard funds, it would look like the following. 25% in Vanguard Total Bond Market Index Fund, VBTLX, to represent bonds. 25% in Vanguard European Stock Index Fund, VEUSX, to represent European stocks. 25% in Vanguard Small Cap Index Fund, VSMAX, to represent US small cap stocks. and 25% in Vanguard 500 Index Fund VFIX to represent the S&P 500. I do like the fact that this fund includes the S&P 500 and bond funds. Also, I like the fact that it's still simple with just 4 funds. The number 7 popular investment portfolio strategy is what is commonly called the Ivy League endowment strategy, a strategy that famous Ivy League schools like Harvard, Stanford, and Yale uses to manage and grow their billion-dollar endowment funds. Now, in reality, most investments that these endowments invest in are hard to replicate for individual investors because they also allocate a big chunk of their allocation to private equity and venture capital. However, in general, when we translate the accessible asset classes and were to construct a portfolio with Vanguard funds, it will look like the following. 35% in Vanguard Total Stock Market Index Fund, VTSAX, to represent US equity. 28% in Vanguard Total Bond Market Index Fund, VBTLX, to represent bonds. 15% in Vanguard Total International Stock Index Fund, VTIX, to represent foreign equity. 11% in Vanguard Commodity Strategy Fund, VCMDX, to represent commodities. 11% in Vanguard Real Estate Index Fund, aka VGSLX, to represent real estate. For me, everything in this portfolio makes sense except for the commodities allocation. The Vanguard Representative Fund, VCMDX, not only has a relatively high expense ratio of 0.2%, but also has a minimum investment of $50,000 and is an actively managed fund. But other than that, if you like the idea of having a portfolio allocation that the most prestigious universities use to manage their endowment, this could be a nice option. The number 8 popular investment portfolio strategy is the coffee house portfolio strategy. This strategy was popularized by investment author and financial advisor Bill Schultheis in his book, The Coffee House Investor. It's got a bit of everything except a kitchen sink. Some S&P 500, some value funds, some small cap, some REIT, some international, and a bit heavy on the bond side. If we were to construct a portfolio with Vanguard funds, it would look like the following. 10% in Vanguard S&P 500 Index Fund, VFIX. 10% in Vanguard Value Index Fund, VVIAX. 10% in Vanguard Small Cap Index Fund, VSMAX. 10% in Vanguard Small Cap Index Fund, VSIAX. 10% in Vanguard Real Estate Index Fund, VGSLX. 10% in Vanguard Total International Stock Market Index Fund, VTIX. And 40% in Vanguard Total Bond Market Index Fund, VBTLX. To be honest, I feel like there's a lot of overlaps here between the different funds. Now, Mr. Bill Schultheis is a smart guy, so I know there's a good rationale behind the strategy. But when it comes to rebalancing, I feel like this could end up being a bit of a nightmare. Alright, moving on to an even more complex portfolio, if you can even imagine one. The number 9 popular investment portfolio strategy is the ultimate buy and hold portfolio that includes 11 different funds. Yes, you heard me right, 11 funds. This portfolio was popularized by Paul Merriman, a successful investor who focuses his effort on educating people on how to invest through his foundation, the Merriman Financial Education Foundation. He has a number of variations of his portfolios, but here's one that captures the different equity asset classes by type. If we were to construct a portfolio with Vanguard funds, it would look like the following. 6% in Vanguard S&P 500 Index Fund, VFIX. 6% in Vanguard Value Index Fund, VVIAX. 6% in Vanguard Small Cap Value Index Fund, VSIAX. 6% in Vanguard Real Estate Index Fund, VGSLX. 6% in Vanguard Total International Stock Index Fund, VTIAX. 6% in Vanguard International Value Fund, VTRIX. 6% in Vanguard International Small Cap Index Fund, VFSAX. 6% in International Small Cap Value Fund. There's actually no good Vanguard representative for this. 6% in Ultra Small Market Fund. Also, there's no good Vanguard representative for this one. 6% in Vanguard Emerging Market Stock Index Fund, VEMAX. 40% in Vanguard Short-Term Bond Index Fund, VBIRX. Are you out of breath yet? I sure am. Though again, I know there's a good rationale behind this strategy. Can you imagine the complexity that comes to trying to maintain and rebalance such a portfolio? But if you're a big fan of Paul Merriman and would rather have someone tell you specifically how to structure your portfolio, this could be an option. Alright, that's it guys. I know I haven't covered thousands more portfolio ideas out there, but I hope this provides a good overview of how complex or even how simple our portfolio strategy can be. Again, I want to reiterate, there is no such thing as a perfect portfolio, only a portfolio that works for you. Pick a strategy that you like and stick with it for the long run. And if you want to change, don't constantly change your portfolio in response to changes in the investment winds. If you'd like to learn why you don't want to overcomplicate your portfolio strategy, check out my video here. Until next time, all the best.